inflation, as I said, has a lot to do with this unit labor cost that I have mentioned earlier on. And this is really the strong, I don't want to use sticky component because it is going to be persistent and we know it. And numbers will continue to be high in the months to come, by the way, because we believe that services are going to continue to go strongly. Labor-intensive services will, contact-intensive services will continue to go strongly. We're heading into the summer. All the summer activities, whether it's transportation, whether it's hospitality, whether it's vacation, all of that is going to go well. So that persistence is to be expected in the short run. And there will be remaining persistency going through into 24. It declines in 25, and we have not revised upward significantly for 25 because we believe that other elements will kick in, which will reduce inflation numbers. It's and unless risks were to materialize, but under the baseline, energy costs are going to continue to, or the cost of, the indirect effect of energy costs will continue to fade. You can still find them in prices, but it is going to gradually fade out. The same goes for food. And we expect that resistance of inflation to gradually fade away. And as much as it persists, we will persist.
Thank you. And the next question goes to Andres Stumpf of Expansion. Andres, please.
Good afternoon, Madame Lagarde. You have delivered quite a strong message about wages, and I'm a little bit scared. Has the risk of an inflation spiral increased since March? And a second question about the projections. If 2025 is not acceptable, do we need to see 2% inflation in 2024 to the ECB to consider that the objective will be achieved in a timely manner? Or what is exactly a timely manner? Thank you.
Well, first of all, on wages, we are not seeing second round effect. We're not seeing this wage price spiral. The only thing that I'm trying to say here is that we have to avoid what I have called the tit for tat, where in response to inflation, both corporates and labor want to receive full compensation, which obviously would possibly lead to that second round effect that I was alluding to. Obviously, the sooner the better in terms of when do we bring inflation back to 2%. But we have to be also realistic, and we have to be measured in the response that we give, but very determined in the delivery of those measures, and persistent.
Thank you. And the next question goes to Jean-Philippe Lacour of AFP via WebEx. So Jean-Philippe, please turn on your camera and your microphone. We cannot hear you, Jean-Philippe. Try again?
Yes.
Yes, now.
Thank you for giving me the opportunity, but I'm afraid that my question was already asked. It was on this wages, and if you see a wage price spiral, the ECB wants to avoid, you said not, but it's a bit a thin difference. You said the wages are having a huge impact on inflation on one side, that's what you say, and on the other side you say that there is no kind of wage price spiral, so it's not really clear to understand. Can you maybe give us an explanation on how you can come to this conclusion?
We just all wish that everything was clear and simple, wouldn't we? What I said, and thank you very much for your question, what I said is that unit labor cost, which is slightly different than wages, negotiated wages, however you want to measure it, but unit labor cost is having an impact, or is rather causing the revision of core inflation projection. That's what I'm saying. And you can certainly have that projection and at the same time acknowledge that today we are not seeing any spiraling of wages and prices that would cause this second round effect that we would be very concerned about.
Thank you. And now to Javier Luengo of Negocios TV. Over to you, please, Javier.
Hi, can you hear me?
Yes.
Okay, thank you for taking my question. You said that the financial markets are not feeling the impact of the balance sheet reduction. Do you expect to be able to increase it on July onwards? And do you think you have room to reduce it?
You know what, I'm going to ask you a favor. If you could repeat your question. The only thing I heard was something that actually I didn't say, but you said I said, which was financial markets will not react to the end of APP.
Reduction.
Yeah, but
I don't know if do you think that you have room to reduce it further?
To reduce it further?
Further, yeah.
Well, you know, we two things. One is the TLTRO reimbursement that is falling due at the end of June, which was anticipated, known by all parties involved, is taking place at the end of June and in early July. It will, as a result, reduce the balance sheet of the ECB by 477 billion euros. The second part of the decision that we made today was to stop reinvesting redemptions under APP and let APP move into a runoff mode. That's all we decided. And that means that, for instance, the PEP continues as was indicated in the only part of forward guidance that we still have in our monetary policy, which is until 2024. We continue the reinvestment and we apply flexibility if and where it is needed. There's no plan to change that.
Thank you very much. That concludes our press conference today. Thank you very much for following. Our next press conference is on 27 July, and up until then, all the best. Thank you.
We were listening to Christine Lagarde, president of the ECB, following the very hawkish statement put out by the European Central Bank. She was speaking in Frankfurt. Taking a look at markets, you can see a little bit of a retracement from some of the earlier highs on two-year German yields, but still those moves hanging in there as people game out how high the ECB could go, with a likelihood of additional rate hikes, possibly even 2 more rate hikes by the ECB. The S&P, NASDAQ, and Russell 2000 all lower. We have opened markets here about 5 minutes into the U.S. Open, and you are seeing the NASDAQ actually leading the charge lower, which is interesting, in a reversal of what we saw yesterday with respect to NVIDIA, with respect to Tesla, all losing some of the recent momentum that they had recently been feeling. Nothing dramatic, but still a bit of a pause. We're also seeing in the yield space, 2-year yields in the U.S. and 10-year yields a bit lower as people reassess the Fed's resolve to really go further. Whether the Fed is hawkish still is up to be discussed, whether their actions spoke louder than what they said. But for the ECB, it was very much a strong statement about being hawkish and fighting inflation. Take a listen to what Christine Lagarde had to say.
Inflation has been coming down, but is projected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. The rate increase today reflects our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission.
Joining us now in Frankfurt, Bloomberg's Maria Tadeo. Maria, very much consistent throughout the conference as well as the statement. Maria, what was your big takeaway from her comments?
Well, a hike, 25 basis points hike from the head of the European Central Bank. She also explained the rationale. A lot of this based on the projections that they put out today. Of course, when you look at inflation, it is still way above target and will continue to be, or would, if you believe those forecasts, until 2025. The other issue that is fundamentally new, and she brought back to this press conference, is this idea of now guiding the market to specific moves going forward. Remember, at a time she ditched and stopped doing that and said this is data dependent and we're going to look at the data before giving any commentary about future decisions. This time around, she did say it is very likely we will hike again in July. Now, she also mentioned not just once, but also suggested and repeated we will hike in July 2 times. She was asked at one point, what is a terminal rate? That is the one point where she has always refrained from putting a number on. So to me, that was also a significant, again, a repetition, a reiteration that we're not done yet. We're on a journey, but we've not gotten to that destination, and we have to bring inflation back to target. So that was the message that she really tried to hammer down in this press conference, which again indicated this is far from over. And also at one point she was asked, would you consider something like the Canadians did, where you hike, then you stop, you assess, and hike again? And she said, well, we're not contemplating that because we have not paused, and repeated that sentence a number of times.
And Maria, that definitely was a consistent message. You're seeing the euro at 108.8, bumping up against 109 as people reassess versus the dollar, the sense that perhaps the ECB has significantly more work to do, possibly one, maybe even two rate hikes, even if the Fed perhaps is a little bit more on the fence. Maria, what's your takeaway with respect to growth and how concerned she was in terms of downgrading their growth expectations, but still not forecasting a recession?
Yes, and by the way, Madame Lagarde has actually just walked behind our press point, so I'm sure she definitely is watching Bloomberg TV to some extent. Well, look, again, she did say that there is a situation when it comes to growth, and this is something that really puzzles economists at this point, is that you see a dichotomy between the manufacturing and the services. She did say over the short term, yes, growth in the euro area is likely to stay weak. It is not even, and you see this divergence between the different components, which is also interesting because historically, certainly over the past decade, and you know this very well, it was the big industrial countries that used to be the powerhouse, that used to be the engine for European growth. This time around, you're seeing that trend being flipped, a lot of that because of the energy shock. The one thing she was asked a number of times, and this had to do with wages, whether she feared that it was trigger or could trigger an inflationary spiral. She said she did not see an inflationary spiral taking hold, but what she did warn and repeat it again is that she does not want to see tit for tat on that respect when it comes to wages, but also say it is time for governments to really take a look at fiscal policy and rein back some of that if they want to really help the central bank achieve this goal, which again was the main target today. We have to get it back to target. She repeated that countless times.
Maria, today, thank you, and a great point there about fiscal policy working at odds with monetary policy, something a lot of people have been discussing. The state of play here is a data dump in the U.S. that gives a conflicted picture, while in the European Union you could see a very resolved central banker talking about the need to bring down inflation. Joining us now to get a sense of what this means in terms of positioning, Invesco's Christina Hooper and Tabakin's Michael Purvis. Christina, I want to start with you. What's your reaction and how divergent do you think the messages are from the ECB and the Federal Reserve?
Well, I think the messages are somewhat different because the central banks are in different places. The Fed has been more aggressive. It started earlier, and so it makes sense that we are in a pause. And I do believe we are. But let's face it, Jay Powell and the Fed want to make sure they keep a lid on financial conditions easing. So that is why they provided us with a dot plot that is essentially a paper tiger. They're hoping to spook markets, to hang a sort of Damocles over markets, so to speak, so they don't get ahead of themselves in terms of excitement that the Fed has ended rate hikes. But I think for all intents and purposes, we're likely to have seen our last rate hike in this cycle for the Fed. The ECB is in a different place. As I said, they started later, and they do have more ground to cover before they get to the point where they can contemplate a pause or an end to tightening.
Michael, do you agree? Do you think that this is basically the last salvo with a bit of a paper tiger attached to it from the Fed?
Well, I think with respect to the Fed, look, I won't be surprised if we get one more hike in on this cycle here. I think but where I think the Fed will go is what I say, really work the x-axis and not the y-axis, meaning that I think they are, and I think these other central banks are as well, seeing sort of new structural inflationary factors that will keep inflation a bit higher than it has been in the past, making that 2% target harder. So I think if we continue to see drops in inflation and a slowdown in some of the economic activity, in the second half of the year, my view is that if my colleague is right here that there are no more hikes, or maybe we get just one more, I think they're going to keep the pause for an extended period of time here and sort of work the deflation battle that way there. I think with respect, I think Christina's completely right that, I think the ECB is playing catch up with the Fed here. But I think one of the overarching messages we've been getting over the last several days from central banks is that the inflation picture is not some sort of giant sort of COVID plus Ukraine transitory 4-year, 3-year situation. There are new structural factors coming into the roost. I might quickly add that one thing I would love to hear from Ms. Lagarde with respect to the European economy, and your colleague was touching on it, is simply that Germany has a lot of wood to chop with respect to how it re-engineers its economy, and it's linked to China in a very significant way, which is doing its own structural changes here. So I think that is where part of that, and there's a lot of pro-inflationary forces coming out of sort of an economic transformation.
Well, Christina, from that vantage point, given the ECB's hawkishness and their projection for a lower GDP as a result to the fight for inflation, or fight against inflation, I should say, are you getting less bullish on international assets, on European assets in particular, over the U.S., which is being supported by this tech dominance?
Well, at the end of the day, I believe in broad diversification, but that does not end my thesis for European stocks. Certainly, valuations are more attractive. We're likely to see a weakening U.S. dollar from here, and so there are reasons to be excited. And let's face it, there is that pretty significant dichotomy in the Eurozone economy. So that suggests active management could perform well in this environment, given that areas of the economy, especially services, are doing well, while manufacturing is facing some significant headwinds. Keep in mind, though, that's a phenomenon that we've seen in a variety of economies, and I think has a lot to do with being in a post-pandemic reopening environment.
And Michael, just quickly here, I'm wondering, from your vantage point, are you seeing more opportunity in the U.S. now than Europe, or is it vice versa because of the stickiness of the strength of the Eurozone?
Look, if you look at European equities relative to U.S. value, which I think is a fair comparison, I think a lot of the juice is out of that trade here. I look at the Bloomberg Surprise Index for Europe versus the United States right now, which is at record extreme lows. In other words, U.S. is certainly surprising much better than the European data is there. So I think there is a chance for Euro to get stronger here, but it's not going to be that surge that we saw in the first few months of the year.
Christina Hooper, Michael Purvis, both of you are sticking with us right now in the markets. We can see the S&P did turn around, basically an about face of what we saw yesterday. The NASDAQ continuing to be just slightly in the red. Russell 2000 still lower, which is something that we are going to discuss coming up. This is Bloomberg. This is Bloomberg The Open. Welcome back. We have been getting word from the ECB. They do plan to hike again, probably in July. They had a hawkish message, and we are seeing a response. In the U.S., markets have been open for about 20 minutes now, and we do see a bit of a soggier tone, particularly in some of the leaders that we saw yesterday, even after the Fed's hawkish skip, pause, whatever you want to call it, and that messaging. Although clawing back from some of the earlier losses, NASDAQ basically flat, the S&P down 0.2%. So with us, Invesco's Christina Hooper and Tal Beckin's Michael Purvis. Christina, I'm curious from your vantage point what the signal was yesterday. With even as yields in the U.S. rose, you had tech stocks rallying, particularly the darlings that have done well all year. Does this signal to you that we have a new safety haven, that basically people are going to go into these tech names regardless of how high yields are?
Well, I certainly think that has been the perception for a while, that tech stocks could be considered defensive just because so many of them actually offer secular growth potential. So if we are going into a slowdown, if we are facing increased headwinds, that tech looks attractive, and there's some really compelling trends there. So yes, I think you could characterize it as something of a safe haven because of its growth prospects.
Are you piling in, or are you just sort of taking a breather too, Christina?
Well, I've always been positive on technology, but I would suggest for those that are looking to enter that it's a good time to dollar cost average in. Certainly, valuations are higher. They're not as high as their highest points historically, but I think there is certainly potential there. There is legs for technology, especially as the economy slows.
Michael, do you agree?
Well, look, I think the NASDAQ at 26 times forward earnings right now with an equity risk premium that's effectively zero begs a lot of questions. And some of the questions that it begs is that what is the earnings profile going to be, over the next, couple of years here at the index level? Obviously, each stock has its own story. But I think what you need to, consider is that, yes, cost cutting will be a great way for big tech companies to keep, beating earnings over the next few quarters. I think that's also priced in quite a bit. AI is a big, exciting thing, but it's also a huge question mark as to what it really means for earnings, putting NVIDIA aside here. So I think you have to be very valuation sensitive here at this point. 26 times is where we got to in November of 2021, sort of the peak of that. And the one key difference here is that, the 10-year Treasury yield is a lot higher than it was back then here. So if companies do not give us a story of real earnings acceleration in the coming quarter, I think you're going to really start seeing that part of the market sell off. And I'm on the rotation trade into more value and cyclicals within the United States.
Christina, just quickly, what would it cause you to do the same as Michael?
Well, I think once there is real certainty that the Fed has stopped hiking rates, and that is our big issue right now, that is when markets are likely to start to look ahead to an economic recovery and start to discount it. And that, to me, is when we are likely to see that rotation to smaller caps, to cyclicals. I think it will happen, but that doesn't mean that areas like technology will dramatically underperform. I think that's a unique sector that has potential even if we see that rotation.
Christina Hooper, Michael Purvis, both of you, thank you so much. Coming up, the market moving events that you need to be watching in our trading diary. That's next. This is Bloomberg. This is Bloomberg The Open, about 26 minutes into the trading day. It is time now for your trading diary, what you need to be watching through next week. Adobe earnings coming today after the bell. Then we'll round out the week with a Bank of Japan decision tomorrow, as well as University of Michigan consumer sentiment. U.S. markets are closed on Monday for Juneteenth. And on Tuesday, Fed Speak resumes. We'll get Fed Speak from Williams and Bullard. In markets, you can see a bit of firming up after earlier weakness. Now positive for the NASDAQ, up about 0.1%. The S&P up 0.3%. Russell still lower as people parse out what higher rates mean for the smallest companies. This was Countdown to the Open. This is Bloomberg.
Got that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, June 15th. Here are the top market stories that we are following for you at this hour. All hawked up. ECB hikes rates and its inflation forecast. Yields pop on the guard. Green lights a July rate hike. Believe me now, the Fed signals the possibility of 2 more rate increases. Markets take it with a grain of salt. We're going to get the view from Christopher Sheldon, KKR's co-head of credit and markets. And housing stabilization or re-acceleration. Lennar beats as demand surges. The stock pops almost 4%. We're going to talk to the CEO, Stuart Miller. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. I was all excited about a 10 basis point increase in the 2-year yield over in Europe, and that, I got to say, has petered out somewhat, and in the U.S. too. Now we see a bid.
Yeah, the market is definitely questioning what we're hearing from central banks, though I will say, Alex, if you want to get a hawkish message across, you give the job to Christine Lagarde.
Yeah.
She has certainly delivered and delivered again. Jay Powell, I think the market was a little unconvinced.
Or just the why. Why were the dot plots actually revised up? Do we really need 50 basis point more hikes? Or is it just sort of making sure that we're not pricing back in cuts and sort of the jawboning situation? So it's like the why behind it I found a little bit confusing.
Yeah, and why not do it this month? Why wait until next month? Is the Fed that afraid? Is the Fed too afraid of surprising the market? They're scared of their own shadow, it seems, at the moment. Are they in that's such a position that they can't surprise the market? Or is it about having a new vice chair and not wanting to make him look bad?
Or is it about different factors driving inflation? Christine Lagarde said over and over about the wage price spiral. In essence, we're not seeing that in the U.S. Powell doesn't really put that as why we're seeing that rise in inflation. Christine Lagarde, though, really talking about that strong labor market. Are we just dealing with different things?
In fact, the Fed seems less concerned about the labor market than it did very recently. So we'll talk about that. We'll certainly figure out what is happening here. But as I say, if you want to deliver a hawkish message, you give the job to Christine Lagarde. This is what she had to say in the press conference today.
Inflation has been coming down, but is projected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. The Governing Council, therefore, today decided to raise the three key ECB interest rates by 25 basis points.
For more on the ECB rate decision, we're joined by Bloomberg's Maria Tadeo. Maria, what did you make of just how hawkish Christine Lagarde was?
Well, you know, it's another 25 basis points hike, and you best believe it will not be the last one, because she's brought back the very, very explicit forward guidance, now really telling reporters, but also the markets, that's essentially who she's talking to, that there will be another hike in July. And she didn't just say it once, she said it twice. And to me, I would go a step further and say, with that kind of statement today, you've also opened up a debate about what happens in September. Now, the other thing that to me was quite striking about this press conference is that in many ways she was asked, would you consider a pause? We're seeing a number of central banks that are going for a skip. What about the Canadians? They went up, they hiked, and then they stopped, reassessed, and hiked again. And she shut that debate completely, entirely. She said it's not applicable to us because we have not paused. Again, repeated this line, we are on a journey, but we have not gotten to our destination. We have to get inflation back to target. And of course, they have to do it when you look at the forecasts that were put out today, all revised up. The other issue to me, and I guess this is obvious as you enter what really is, to some extent, the end game for the ECB too. We don't know how many hikes are left, but we know they're approaching that point where you have to really consider where you stand. Is that she did say the decision today was, quote, harmonious. She pointed to a broad consensus, but she did not mention the word unanimous. That's happened in a few meetings already. So it does show the debate is probably lively behind the scenes.
Well, we know where Maria Tadeo stands, and that is inside at the ECB. Maria, fantastic work today, as ever. Thank you very much indeed. They need that big Euro sign outside in the new building. It's outside the old building still. Just move it. It's such a great and iconic image. Okay, Maria, fantastic. Thank you very much indeed. Maria raising the question, is September on? And what should we make of the hawkish message and the market response to it? So our question, we're going to run this throughout the next couple of hours. Central banks sound hawkish. Should you believe them? Do you believe them? Joining us now, Carsten Brzezinski, ING's global head of macro research, chief Eurozone economist. Carsten, she sounded hawkish today. Is September on? Should we believe the hawkishness coming from the ECB?
I think we have to believe the hawkishness by Lagarde. Very honestly, it's not only her words that keeping the door open. It's also when you look at the ECB's inflation forecast. So next year, still 3%, far off target. For 2025, the inflation forecast slightly revised upwards, now also above 2%. So just staying in this own logic of the ECB, in its own reaction function, I don't think that the economy will have worsened enough by the September meeting that the ECB will actually skip the September meeting. Mm-hmm. So they will continue. And I think it's very likely that they do September as well.
Carsten, why aren't bond yields higher then?
probably they don't believe it because they think that the ECB is too optimistic. And I think there's also a point to be made. When you look at the growth forecast by the ECB, I think the ECB is the last man standing when it comes to the optimists about Eurozone growth. The ECB still has the European economy returning to potential growth before the end of this year. And I think given everything, the looming recession in the US, the stuttering recovery in China, the delayed impact of rate hikes so far, I think it's fair to oppose such an optimism. And if then the real world turns to be out much worse when it comes to the economy, I think the ECB will also have to revise downwards its inflation projections. Only question is, will they do this already in September or only in December?
Okay, let's talk about those inflation projections. Carsten, core numbers are still elevated for a very long period of time. 2023, 5.1 versus 4.6. 2024, 3% versus 2.5. 2025, 2.3 versus 2.2, the earlier forecast. Basically what they're signaling is the core will not come back down to target until after 2025. Is that realistic? Where do you think that number is going to be in 2025?
I think it could be lower, in all honesty, Guy, because when you look at historical evidence, when did we have the last time energy shock? That was in the 70s, and there it always took like 6 months before core was following headline inflation on the base of negative energy effects. Same as when you currently look at manufacturing prices and services prices. So a big chunk of core inflation in the Eurozone is driven by higher services prices. But we also know, at least from historical relationships, that services are following up on manufacturing prices. So if this also holds this time around, we will see core inflation coming down in the second half of this year. And I think we could see it coming down faster than the ECB has currently penciled in its forecast.
But Guy, this goes to the point we were talking about earlier at the top of the hour. What drives the different inflationary inputs here in the U.S. and then over there, for example? So if here it's going to be driven by something like, if we're going to call it greedflation, but there it's wages and the labor market, we're dealing with different kind of things here.
Yeah, and the wage market, the labor market in Europe is much different in its structure to that seen over in the United States. Much less flexible, much less rigid, so once inflation gets in, it's much harder to get out. Carsten, what is the line between Eurozone inflation and the Eurozone labor market? How strong is it?
It is pretty strong because unions are obviously also listening now to what the ECB has to say. They are listening to where the ECB thinks inflation is going to be. Interestingly, unions have started to criticize the ECB for bringing a rate up too high. So that the unions are currently also a bit concerned that the ECB is more or less on purpose choking off the European recovery. And this means that I think that we will see less strong demands coming from unions. So what I expect is probably for this year, wage growth in the Eurozone around 5%. Next year, maybe 5%, slightly lower. And this should still be enough to avoid a wage price spiral, because we currently, that's also gone, we don't see a wage price spiral in the Eurozone.
Okay, so we don't see that. Yet the talk about the long and variable lags being even worse this time around, the transmission mechanism just taking a lot longer. Why are we seeing that? And we're seeing that here in the U.S. too. What's the reason behind this?
I think it has also to do with the 50% of the economy is psychology. And the economy, look at the housing market, it is trying to find a new equilibrium. So people, economic subjects, are trying to find, where is this real price? Should I start buying again? Should I start investing again? There is also a high amount of uncertainty in these economies. And this is why it takes a while. But let's also not forget, we haven't even celebrated the first anniversary of ECB rate hikes. They only started in July last year, so we haven't had 12 full months of rate hikes. So it will come, that's for sure. The impact will come. And I'm a bit afraid that the ECB has not taken this into account enough in its latest economic projections.
So that more that growth then maybe rolling over too. All right, really great to get your perspective. It's going to be super interesting. Carsten Brzeski, ING Global Head of Macro Research and Chief Eurozone Economist, thank you so very much. All right, so coming up to the U.S. Central Bank, the Fed pausing their series of interest rate hikes, projecting borrowing costs will increase because of that persistent inflation and the labor market strength. And Barry Threadneedle, partner and founder, shares her perspective next. This is Bloomberg.
We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
That was Fed Chair Jay Powell yesterday talking about those lags on the Fed's decision to pause interest rate hikes. Powell also suggesting that rates would rise more this year as inflation remains stubborn. Just take a look at that dot plot. So our question of the day, come looking at the bond market, you see a bid into the front end now as even rates over in Europe cool off a little bit. Central banks sound very hawkish. Do you believe them? Joining us now for Perspective, Ann Berry, Threadneedle partner and founder. Ann, do you believe them?
I believe them. When someone shows you who they are, believe them. And I think Jay Powell has been consistent. The Fed's going to be data-driven, and they've responded to the data as it's come in. They saw core inflation still not where it is, but starting to trend down, and they paused.
Why doesn't the market believe them, Ann? There's plenty of people out there that are questioning the Fed, questioning whether they can deliver 2 more hikes this year, questioning whether or not we are going to be seeing the data develop in the same way as the Fed sees it. Why is the market unconvinced? What is the market seeing that makes them unconvinced, do you think?
Guy, I've been puzzled by that, frankly, for the last 6 months now, but I think the market is sitting there trying to make sense of lots of different data points, and I think at the core of some of this is the fact that the data that the market looks at tends to be a little bit more real-time, a little bit different from what the Fed tends to look at. The market tends to be more forward-looking, tends to be more trend projection-focused. The Fed tends to have, a slightly more backward-looking or more recent data bias, and I think that's where we're starting to see a disconnect. There are some signs, for example, in auto loan defaults, that the consumer is starting to feel the pain. We're seeing a lot of forward-looking pain when it comes to commercial loans, for example. So I think that's where we're seeing the forward-looking perspective of the market and the more recency bias of the Fed beginning to part ways.
Okay, so if we have to look not on an index level, but sort of parse through a little bit,
yeah,
is it as simple as like you want to buy a little small cap, buy a little tech, like that's your barbell right now?
Alex, I think it's tricky. And just to disclose, I have a very boring portfolio. I've been super focused on dividend yield, just super focused on making the most of really great returns to cash. Tech, I think, is a curious one. I think it remains overvalued for the most part. But I think there are some pockets in there, particularly on the B2B side, where you're seeing much better execution than we've seen for the last 2 to 3 years, and margin uplift as a result. That's pre-AI hype. We're starting to see management teams really focus. And we're really starting to see, I think, the winners beginning to benefit from businesses wanting to consolidate their spending with some of the biggest players. I think that's where I'd look to play growth. Small cap's a little bit different. I'm looking at some equipment players that are taking a different approach.
And so you're not feeling FOMO at this point? You're not feeling that desire to chase some of these incredible returns that are being generated by AI?
Guy, I'm not feeling FOMO. And actually, the great benefit of having been trained on the private side is you can't actually feel FOMO because you can't trade in and out of your positions. You have to have conviction for the longer term. And what I think is really interesting about the AI narrative, I think there is consensus that to see the real benefits of AI, you've got to be in it for the long haul. So much is unknown right now. And so I think having the perspective of taking a step back and saying, okay, where are the secular tailwinds? It is going to be where you've got real uses of generative AI. It is going to be on the industrial side where you're going to see real integration of data so that you've got, for example, demand planning tying to how you manage your inventory in a much more integrated fashion. But to take that perspective, you've got to be willing to ride out capital replacement cycles. You've got to be willing to look at proof of concept on the software side. You've got to take the longer term view, and you can't have FOMO to do that.
Right, so it's going to be an investment thesis, not a trading thesis for AI at the end of the day. You mentioned small caps equipment makers?
Yeah, well, less on the small cap side
in general,
but in general.
Like that's where you're taking on the quote-unquote risk.
Yeah, I think there's some equipment, which, by the way, it's going to be a bumpy ride because even though the view is there's going to be a soft landing, there is still a very high likelihood there'll be some kind of recession or correction. I'll give you an example, Alex. A story recently that was interesting was Deere & Co. That really captured the imagination, where you can get an equipment manufacturer that really owns farming and agriculture, now really penetrating using data and smart agronomy to build share. Let's take that, for example, into medical devices. So I'm starting to look at places like Medtronic, which has had execution issues, but you can't argue with the fact that they're a winner out there in terms of medical imagery that will benefit from AI over time, and you're going to have to see hospitals and clinics and medical providers really buy into a new capex cycle over the longer term.
And fundamentals matter, but when you're getting big macro moves like we're seeing at the moment, and this is a top-down, liquidity-driven market, How much do those fundamentals really matter on an individual stock-by-stock basis?
I think it depends on the sector, guys. So, for example, when you're looking at liquidity constraints, and obviously you've got to look at things that are heavily tied to consumer spending, as I said, like auto, you've got to look at the financials, you've got to look at banks, where you're going to see contraction in terms of what they're able to actually execute on for both corporate and consumer borrowers. So I think on a stock-by-stock basis, looking for those individual names that are less exposed to a potential credit crunch becomes very important. So, for example, to pick, Walmart is one that I've been piling into that's worked out very well so far, or where the ticket is small enough that's less exposed to borrowing risk. That's important. But again, if we want to invest rather than trade, you're going to have to look past what the near-term restraints are going to be.
You called yourself boring. What would make yourself not be boring in your portfolio?
Oh, well, some of the things have been a little bit more glamorous, Alex, have been Spotify. I'll give you an example there. It's still tied to this thesis of, I think, the big get bigger. If you want to find one name that's all about how, in this case, the consumer is consuming music, Spotify is the name that you go to. That's a little bit less boring. One of the other ones out there that I think is starting to get a little bit more interesting is Amazon. I've talked about Amazon tons in the past, but if you look at what they're doing with Prime Video, what you're looking at on the content side, I don't think they've mined their full potential quite yet.
Anne, thanks a lot. We really appreciate it. Perfect perspective. Wait, it's not boring. And Barry and Fredino, thank you so very much. All right, still ahead talking tech. Microsoft is on pace now to close at a record high as the tech giant bets big on AI, preparing to cash in well ahead of its Silicon Valley rivals. It's today's big take, and all those details coming up in the startup next. This is Bloomberg.
Do I think there will be another 1 to 3 companies that will be the size of the 5 big tech giants emerging, possibly from AI? Absolutely, yes. Now, does that mean that, one of them is going to collapse? No, not necessarily, and it doesn't need to. The more that we have, the better.
That was Reid Hoffman, OpenAI investor and LinkedIn founder, speaking with Emily Chang. It is part of Bloomberg's news show, The Circuit, in which Emily goes behind the scenes with the world's most influential founders, influencers, innovators, and gains fresh perspective on the future of technology. Watch more of this week's episode on AI and tune into The Circuit with Emily Chang tonight, 10 p.m. in New York, on Bloomberg TV. You can go ahead and stream it at 8 p.m. on Bloomberg Originals. So let's stay with tech and this AI idea here. We're past 22 minutes. Can't talk. Minutes past 7 on the West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts its foggy morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, the topic of today's big take is also Microsoft and its big bet on AI and how it just kind of leapfrogged over Google and no one kind of knew about it until now.
Yeah, I mean, that is the framing of the big take. You know, this time last year we were talking about the new Top Gun film, and if we were talking about artificial intelligence, we were probably doing it in the context of Google and the work that Google was doing in research. And what the big take does, it unpacks the kind of behind-the-scenes journey that Microsoft took, starting probably in 2019, when it started serious investment into OpenAI, through product development 2020, 2021, and we all know the story since November. It's leapfrogged Google, but what it's done is commercialize the technology, offered it into the real world through integration with existing Microsoft software. And we've covered those stories daily here on the startup, but it's definitely worth a read, the big take.
Ed, it looks like Microsoft may be on pace to close at a record high. Why is it taking the market so long to figure this out? And what is the connection into OpenAI? And what is the connection into the rest of the AI landscape? You talk about the fact that Microsoft's been doing this quietly. It's got some pretty sizable stakes.
It has. So there are varying estimates out there of what commercializing OpenAI's large language models and integrating them in software looks like on the top line. But it's in the tens of billions of dollars of added revenue in the years to come, and that's outlined in the big take. Everything has happened very quickly. The market's response year to date is fascinating. The gains in Microsoft are not to the level of NVIDIA, for example, because NVIDIA was a real terms beneficiary in terms of people buying up GPUs because the GPUs are needed for the compute part of building and training large language models. But go back to that commercial aspect. You know, Google was always so risk averse of taking its research-focused development of large language models and putting it into their sacred commercial products, which is Google Search. Microsoft did it. And in answering your question about the market's response, the market also recognized that Microsoft's actions induced a response in Alphabet and Google, who had to move quickly and declare a code red, bringing the work that they've done in large language models and rolling out generative AI tools across search and also their other online suite of software tools as well.
Ed, do we know where the AI glass, what am I talking about, telescope is going to go to next now?
You mean Google Glass?
No, I mean like literally, like we have NVIDIA and then there were other companies and now
where's the spotlight going to fall next?
Thank you. Telescope, Google Glass.
So go back to what Reid Hoffman was just talking about in that clip, the next big technology company. The question that the big take poses is whether OpenAI becomes that company on its own 2 feet. Or should we think about OpenAI as just a very well-funded subsidiary of Microsoft? You know, they've invested $21 billion in that company so far, approximately, according to sources, but they've kind of ingested it, provided all the compute. So that's the way that I'd frame it. Is it OpenAI or is it Microsoft, Google, or someone else?
Alex doesn't know what a spotlight is. It's always on her. That's the reason why. Ed, great stuff. Thank you very much indeed. Ed Ludlow. Ed and Caroline coming up a little bit later on Bloomberg Technology.
authority.
We're about an hour into the U.S. trading session. Equities higher, yields lower. Abigail Doolittle is tracking the confusing moves. Abigail?
It is confusing, Alex, because this is not the screen that I would expect to be seeing after yesterday's dot plot or even Fed Chair Jay Powell. They're talking about a 560 median rate at the end of the year. Markets are pricing in closer to 520, so there's a big divergence there. If I was a betting person, I would be betting with the Fed. They've been right over the last year and a half, these bond traders getting whipped around. Nonetheless, stock traders have been pretty accurate, even though often people say the credit traders are better, but here we have gains, a sixth up day in a row, the S&P 500's longest winning streak going back to November of 2021. Now, if we put this into the perspective of the chart, I wouldn't be surprised if we go back down into a range. This is a new way of looking at the range. It's been developing. This is actually a bearish range. It could break to the downside. There's the breakout of last year's bear market. We're going higher, but this does really support the idea that we could go back down to 4,000. What would support it? Well, let's take a look at what rates are doing, because we have the 2-year yield over the last 30 days backing up 85 basis points. Yesterday at one point at the highs, up basically 1% in a very short period of time, round tripping it from when Jay Powell spoke back in March to Congress before the Silicon Valley Bank incident, which gave them a ton of room. But if we go back above 5%, let's see what happens. As for commodities, it's a risk on tone as well. Commodities higher, higher, higher. The Bloomberg Commodity Index of 1.4%. And check out natural gas, Alex. The volatility there continues. Risk on tone, but I agree. It's kind of confusing.
All right, Abigail, thanks a lot. Really appreciate it. Let's see if we can get some clarity. So in the credit markets, KKR sees a shift underway in corporate credit as borrowers shy away from leveraged loans in the wake of a banking crisis. Now, in a note emailed this morning that's titled Crisis of Confidence, Christopher Sheldon, co-head of credit and markets over at KKR, writes, a lack of confidence has profoundly altered the credit landscape since the U.S. Federal Reserve began aggressively raising interest rates. Without knowing where interest rates and ultimately the economy will land, lenders, borrowers, and investors have increasingly decided to wait and see. Christopher joins us now. Chris, good to see you in studio.
Yeah, thanks for having me.
Okay, so did you get any confidence? Do you have more confidence, more clarity than you did yesterday?
No, I mean, Abigail's a perfect example of saying she's being surprised about what she's seeing in the bond market versus the stock market, and that's exactly what we've been saying. Is just there's just a lack of conviction, confidence, and consensus in the market right now.
Christopher, good morning. I read the letter. I have it here. I read it on the train this morning.
Thank you.
And you need to check whether Alex did as well.
I did.
I'm just going to put.
I gave Guy a lot of shade on our pre-call about not reading the letter, but go ahead.
I read the letter. I got the shade. I read the letter. Look, so what do we need to see from here on in? What do we need to see for that confidence to come back?
Look, I think it's just time, and it's a bunch of inputs, and I think what we saw yesterday with the Fed is consistent with what we've been thinking, is we're just in a place where rates are higher for longer, which probably means equity valuations lower for longer, and we're in a sort of a waiting game, and it's a little bit of inputs, mosaic theory of bringing a lot of those inputs together so confidence builds. I think the one thing to sort of pay attention to is, because a lot of people are sitting on the sidelines, because the capital markets activity is slow, cash builds. And our view is you need to start deploying now, because all of a sudden, once the confidence comes in, it's going to be like a tinderbox ready to explode.
So the volatility and the pain could come on the upside once you get the confidence.
Absolutely. And a lot of people talk about volatility on the way down, but a lot of times volatility on the way up is so much more vicious.
What if the Fed over tightens? What if we get a recession? What if we don't just get a kind of regular recession? What happens if we get an aggressive recession?
Yeah, I mean, that's not our base case, but you hit the nail on the head on what would cause it, is that the Fed overshoots. And that's one of the reasons why we like credit over equities. Just from a risk-adjusted basis, you're getting paid so much right now. It's a lender market. You're getting the structures. You should be deploying now, and that's going to weather that buffer, right? I mean, if you're getting 10% cash on cash, if you don't time it right, or if we do go into a deeper recession or into a recession, keeping it simple and part of credit, getting higher coupon buffers that a lot.
So you like high yield?
Like high yield.
What else?
I like private credit, and private credit gets categorized.
Doesn't everyone like private credit right now?
Everyone likes private credit. What we like about private credit is senior secured capital structure, getting cash on cash. The flip side is there's just not a lot of M&A. So where we've been deploying is having scale and having a big incumbent book. But if you really like this vintage of private credit, you really should go subordinated and get the real multiple money. So we like subordinated credit, we like private credit, we like capital solutions transactions right now, so bridging some of those hybrid structures right now, whether it be growth companies that were hopeful to go public, can't raise a down round or go back to their equity holders and providing a sort of a preferred structure right there. So we like credit in general. The areas where we really like is being that liquidity provider when others are looking for liquidity, and that could be new issue because they're forced sellers, or it could be buying assets like asset-based finance or collateral-backed debt off of regional banks.
You don't like leverage loans. Is that a structural shift?
No, I don't. I still like leverage loans. I think, look, the private equity community has used leverage loans over the last decade. So if you look across our credit book globally, our leverage loan debt to EBITDA is higher than our unsecured high-yield bond book, which just shows you the high-yield bond market is the highest quality high-yield bond market we've seen. So there's definitely more credit risk in the loan market than we think the high-yield bond market, despite being secured. The technical in the loan market, 70% of that holder base is CLOs. CLO market is not producing new CLOs as it has in the past, and so I think that's the technical that we're sort of.
When does it come back? Does it come back, or is this?
It will come back. Of course, it will come back. I think it just takes time. A lot of the buyers of the liabilities have been banks, so it just takes a lot of this glue to get out of the gears to get things going. And so what, Guy, to your question of what brings this all back and what brings confidence, it's just a lot of sort of time, cash building, and sort of confidence, and then that will bring back the CLO market.
When you think about M&A and what kind of M&A is going to get done in the environment with the lack of risk that is kind of wanting to be taken right now, Christopher, what kind of M&A are we going to be looking at, and what kind of deal flow should we be thinking about kind of relative to recent history?
Yeah, I mean, I think there's a lot of private equity dry powder out there. The last number I heard was about $1 trillion. And the last time I checked, that money usually doesn't get given back, right? And so that will get spent. Look, I think in private equity, privates to privates are going to be harder, right? I think the ability to get operational efficiencies are more challenging. Where we've been busier in our private equity business has been public to privates or carve-outs of public companies or bigger conglomerates. There we can bring our operational efficiencies, we can bring a little bit of our secret sauce and really manage around the equity returns to this high borrowing costs.
What is the pricing difficulty now? I mean, like, public to private means you can look at the public market and be like, oh, look, there's the price. How wide is the spread in the private market? What's so hard to price?
Look, I think the bid-ask is still there, and that's why we haven't seen a lot of M&A activity. I think at some point...
Is it getting closer, or is it
I think it's getting closer. I mean, our pipeline and our direct lending and private credit book is growing. From what I hear from our PE colleagues, we're getting more and more pipeline. We just announced a transaction recently on our private equity business. So it's happening, but a little bit of that lack of conviction, consensus, confidence is also in the broader market. So it's not forcing people to sell or actually saying I'm willing to sell.
Let's talk about which child you prefer right now. Do you think I'm going to get a better return off the credit side or off the PE side?
Look, I mean, I think if you do private equity right, I think you'll always get a higher multiple money than what you're doing in credit. I think right now, given so much uncertainty around the economy, where we're going, from a risk-adjusted basis, credit is so attractive, and that is liquid credit, private credit, collateral-backed or asset-based finance, and even real estate credit. And I think that's where it should be an increasing part of people's portfolio from a risk-adjusted standpoint. And to your point, if the Fed overshoots and you get the recession or the macro wrong, you have a big buffer given just how big the coupon is today.
Also, then scale counts, how much money you can deploy. So last question, there was a great article on the Terminal that talked about how banks are pulling back, as you mentioned, particularly in Europe, and that a lot of guys like Blackstone have stepped in and become direct lenders. Where are you noticing the most activity in that space?
Most activity in that space is actually in asset-based finance. So it's a hunt for capital everywhere. It's even more of a hunt for capital and liquidity at the banks. And so what they're doing is they're selling the highest quality assets, pools of collateral-backed loans, hard assets to free up that liquidity, and they don't want them, sort of managing around losses too. So they're selling the high quality assets and to free up that liquidity, and that's where we're seeing a lot of the volume right now.
Great stuff, Chris. Really appreciate. You're not waiting for Godot to put money to work. Some people are.
Oh, yes.
Yeah, you got to do it.
She read the letter. So, Alec, she hates that play, but loves that play. So maybe the fact that you mentioned it would have gone down very well, Chris.
I really do hate that play. All right, Chris, thanks a lot. Chris Sheldon of KKR. We super appreciate it. Coming up, you got homebuilder Lennar reporting yesterday, better than expected earnings. You got pretty solid new home demand. We're going to talk to Stuart Miller. Lennar chairman joins us next on what all of this says about the housing market. This is Bloomberg.
Well, certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates, and we certainly saw that over the course of the last year.
All right, let's stay on housing here. Lennar boosting its forecast, did pretty well. That stock up by over 4%, had solid guidance for 2023. The stock moving a little bit higher. Let's get more on this with Simone Foxman. Simone?
Yeah, Alex, for so long, the Lennar story has really been dominated by interest rates. We saw share price dip last year ahead of that rating cycle, but now we're hitting an all-time high for these shares, up 33% this year. And part of that is what's happening in new orders. We have a chart of this. They are growing. They outperformed expectations. New deliveries also revised higher for the year. There was a lot of positive stuff in this earnings, and the other thing was margins. Those coming in ahead of analyst expectations at 22%. That's positive for the story. Shows that Lennar is keeping costs in line. Part of that may have been improving prices of lumber, but we'll get more on that. The chairman, Stuart Miller, talking about how consumers really in a new normal with interest rates mortgage rates at about 7%. The question I want to know is, does that change now that we have the Fed talking about potential for more interest rates, even more than many expected in the future?
All right, Simone, thanks a lot. It's a really good setup. Stick with us for more. We're joined by Stuart Miller, Lennar Executive Chairman. Stuart, I'm going to kick it off here. Why did you do so well? How is housing demand so strong when all we hear about is how affordability is way too high?
Okay, so let's remember, let's go back a year and remember that the home builders as a group, Lennar as well, really took a big step backwards, both on margin and on volume, when the Fed started raising quite aggressively about a year ago. And so the pain that was felt in the home building world dates back a year. We've been going through it and sorting through it over the past year. Secondly, I note that there is a well-documented supply shortage of housing. It is 15 years in the making. We've been underproducing the housing that is needed in the country for over 15 years since the Great Recession. And that's not going to fix itself quickly. And so there's been a reconciliation. The consumer has had to go through an adjustment. It started with sticker shock and migrated to affordability. Over the past year, there's been a reconciliation in pricing. There have been interest rate buy downs that have been initiated by the industry. And while the existing home market has continued to suffer, in part because there's no inventory, people with low interest rate mortgages don't want to put their homes for sale, and in part because there's been that reconciliation with the customer, we're now seeing demand come back to the market and fulfill need within the country, and pricing and interest rate buy downs have enabled that.
Well, Stuart, look, I'm looking at the bank rate 30-year fixed rate. It's at 7.1% today. What gets consumers to give up the 3% that they have on their existing home? Or is this all new demand from new buyers of homes?
Yeah, I think that those that have that 3%, 4% mortgage are going to be very reluctant to give up that interest rate. They have equity in their home. They have equity in their mortgage. So this is new demand. This is a lot of the unraveling of doubling up, people that have lived at home for with their parents for an extended period of time, coming to market. Household formation remains strong. So this is just the market revealing the underlying demand that has been on hold for the past year.
Stuart, okay, let's talk a little bit about how we build more houses. How does America build more houses? What do you need to have happen to build more houses? Are you constrained by labor, by lumber prices? What is going on, and what has been going on for so long that is basically preventing America building the houses that it needs? And how would you solve the problem?
So this is exactly the question that is confronting mayors and governors across the country right now. The recognition that it is especially affordable workforce housing that is in short supply. And it derives in part from land availability. And when I say land, when you fly in a plane, you see land available across the country. It's entitled land that's ready to be developed and to be put into production. There is a shortage of land. Land developers are finding it hard to get access to capital. So land prices have been moving up because of short supply. Production prices have generally moved up, although moderated over the past year, and we've seen production costs, the costs of sticks and bricks, start to moderate and come down. And so you have a math problem, and that is it's expensive to build, expensive to buy land, expensive to build, and very difficult to make homes affordable. What do we have to do to solve the problem? We're going to have to get more land available at shorter entitlement times with lower fees to bring costs down, and we're going to have to see some more reconciliation in the cost of production. Over time, I think we can make this happen, but it is going to